Okay, good day. So while waiting for the others, I think we can start. And today, um, y- we have like two chapters today, but I think I will focus on the cost of capital because it's more, as always, it's more quantitative. The other chapter, the chapter 14, is about country risk, and yeah, I sent you the materials, and you can see that it's qualitative by nature. So. You could imagine it easily as well because it's talking about country risk. If you go to countries like developed countries like the United States or Europe or Singapore, Japan or anything, of course the potential return is lower, lower potential return because the competition is tougher. The products, the product market is saturated, and yeah, so you can imagine. So if you go to like better and better countries, potential returns are lower, but of course the risk is also lower. Right? We know that in the investment, in the investment world, we know that the higher the risk, the higher the expected return. Right? High risk, high expected return. But if you go to some maybe less developed countries, we call it LDCs, less developed countries, or developing countries, or even undeveloped countries at all, we know that uh, the potential return is high. You can imagine if you go to maybe an African country, especially the like less developed ones, uh, of course you can sell anything, and if it sells well, then you earn a lot of money because the competition is less stiff. Right? The competition is almost non-existent. Or maybe to your neighboring country, you can imagine if you go to North Korea and you open something like Lotte Mart or something, then you can sell very well. However, the risk is high because you may not be able to get out alive, right? So this okay, that's the reality. It's the same if you go to like Afghanistan or Iraq or Iran or anything. Of course, you can sell everything very well, but again, the risk is very high, and even survival chance is uncertain, right? We may not be able to get out of that country alive. That's the problem. Right? So as always, so that's why chapter 14 is quite straightforward, quite easy. So today I think we will not focus on that one because it's quite understandable. If you go to a very developed country, it's safe, the system is there, certainty is there, regulations are in place, but of course the competition is stiff because you have to fight with everything. Can you imagine if you are Hyundai, you go to the United States, then you have to fight with what, General Motors, you have to fight with yeah, General Motors even has a lot of subsidiaries like the Chevrolet, the what else, Buick, uh, Cadillac or everything. And we also have like Ford, another competitor at Ford, uh, Chrysler, and we have the some other countries like Mercedes, Volkswagen, and also Toyota and everything. So you can imagine the competition is really tough. But of course, the risk is lower because everything has been in place. Right? The risk is low, regulations are quite certain, law enforcement is good, law certainty is also strong and everything. So yeah, we can imagine. But if you go to like less developed countries, potential is high but dangerous. That's I think always trade-off, the trade-off between risk and expected return. Now today, actually, we try to quantify that fact into our analysis and discussion on the cost of capital. That's the interesting thing, right? So for the chapter 14, we see the qualitative concept. Of course, we know that if you go to like a more a riskier country, right? Country with a higher risk, the expected return is also higher. But how that reflects to like the cost of capital and also the project feasibility, we are going to see it today and also next week. Right? Oh, by the way, exam after next week, I think next week will be our last session, I guess, right? October 24th. Uh, we have a short exam. It's about 2 hours. Uh, the exam questions will be put on iCampus, and then you can do it anywhere you want for maybe 2 hours, and then you submit your submit your solution papers to the iCampus again. Quite straightforward. Okay. Okay, so that's about exam. Maybe I'm ahead of myself, but yeah, just for your information. Okay, so after the last session next week, I don't know, maybe the week after or within several days, you have that kind of exam. So it's take-home exam. You can do it anywhere you want within 2 hours. And I could guarantee you that the questions are normal, okay? No spectacular questions, not what's that? No traps, okay? No spectacular difficult questions, like just normal, right? Normal questions, you can do it in within 2 hours and resubmit it on iCampus, okay? So don't worry about it. Yeah. Okay, so yeah, let me start the cost of capital. You can see my slides now, can you? Okay, so cost of capital. So after talking about the country risk, again, high risk, high expected return. If you go to a less developed country, the risk is higher, but of course the expected return is higher. So you have less competition, your products can sell more, right? And the standard is also lower. You can imagine, like, if you go to, you see the case, when I was in the United States, I saw a lot of recalls, right? Recalls for like Toyota cars and everything. So even there was nothing happening to the customers, but the company recalled the cars. Because you know that in a country like the United States, the court settlement is very expensive. You can imagine if someone is driving the car and then hits a tree or something, and then he or she gets injured, then he or she will sue the company, and the company will have to deal a lot of matters on the court, and the company will have to pay, right, for settlement. So even before anything happened, I saw a lot of companies recall their products. One of them was Toyota, right? There are a lot of events when Toyota recalled their cars. So this kind of thing may not prevail in other countries. Can you imagine if you're a car producer and you sell it in, wherever, maybe Indonesia or Laos, Cambodia or anything. I think the standard is not as high as it is in the United States or even in Korea. You can imagine that. So even if you have like slightly defect products may not create any problem in those countries. So you understand what I'm saying, right? So the risk is low, the potential return is high, but the risk is high. Because in a less developed country, anything could happen. Maybe political stability is not that strong, and law enforcement is not that high, or some other things that you could imagine, right? So how that reflects into the financial perspective, then today we'll start seeing the cost of capital. So I told you also my previous videos on the cost of capital for corporate finance. I hope it's useful, but I think it's worth repeating. Okay, so we'll start again. So cost of capital. So we are talking about cost of capital for the general company. So before we see the context of the international cost of capital, so I think it's worth repeating a bit. So I'll start with Jinsu again. Jinsu, you're the first on the screen. You're the first who came to the class also. So cost of capital. Can you tell us again? What is actually the cost of capital, in general term, not necessarily international context?
It's for example, it's uh, 10 10 years 체코를 뭐라 그러지? 10 years what credit 10 years bond
Okay.
bond rate
Okay.
is in Korea 1.5 interest rate is 1.5. I think that is cost of capital.
Excellent. Excellent, Yinsu. Yeah, that's right. So that is one of the components of the cost of capital. That's very correct. We call it cost of debt, right? Cost of debt. But yeah, excellent one. So let me just repeat a little bit this concept so you can understand fully. But that's absolutely correct. So cost of capital, you see the word here, capital. By capital, you understand, I think, in your own language. So the capital has a cost. The capital has a cost. That's why we call it cost of capital. So maybe my first question now, me, who supplies capital? Who give you capital?
Country?
Say it again.
Maybe country?
Yeah, possible. Possible government.
Yeah,
Could be government.
or by myself. Yeah.
Yes. So
Yes.
what is the general term for that? So who is that? I mean, the general term for people who supply capital. What is the name for? What is the terminology for that? People who give capital. Was that in what? Was it?
In country, I think. No?
Yeah,
Investment.
yes.
Investment. Yeah.
Yeah, investors. Yeah,
Mm.
investors, including the country, creditors, and everyone, right? So anyone could be investors. That's right. So including yourself, could be yourself, could be the country or the government, right? Could be creditors and everything. But again, the question is who supply capital? The general terminology is investors. So Moon, can you tell us who are our investors? Can you give examples? Who are investors again?
Stockholders.
Yeah, stockholders. Yeah, that's right. Who else maybe you can think about?
Liability, bond.
Yeah, creditors. Creditors are people who lend us money. For example, banks, bondholders, like what Jinsu said, the bondholders, including the government if they give money also to state-owned enterprises and everything. And could be many, could be preferred stockholders, right? Could be preferred stockholders, could be warrant holders, anything. So many. These are just examples. So to make the case simple, I will just use these two of these because these two are the most famous one, right? First, most famous. I mean, everybody knows about this. So investors, stockholders, and creditors. Next one. Sungwoo, if I rephrase my question.
예. 천안 쪽은 내가 잘 몰라가지고 교보는 아니고 다른 데인데 서울에 있다가 이제 천안 쪽에 발령이 나서 좀 오래 있을 것 같아서 그걸 그 천안 쪽에 아파트를 하나 이렇게 겸해서 알아보고 있는 것 같은데 보니까 그 친구가 이야기하기를 천안역 쪽에 그러니까 교수님 사실 쪽은 그 신도시 쪽이잖아요.
Okay. Who is that? Could you please turn off the audio?
과장님, 전화 다 들립니다.
Okay. Yes, it's a nice language. It's like singing, right? Very good language. I mean, I have been watching a lot of Korean movies, but I still don't understand at all. Okay, so yeah, nice one. So Sungwoo, if I rephrase my question, okay, why are they called investors? Why do you call them investors? The stockholders, creditors, why do you call them investors?
I think they are capitalizing.
They're capitalizing, yeah.
So
they give you money.
investor. Yeah.
Yes, that's right. Very good one. So
yeah.
Yeah, go ahead.
Oh yeah.
Oh, okay.
Yeah.
That's right. So they're capitalizing. They give you money as capital. But there's one more requirement, one more prerequisite that could describe the definition of investors better. Something that you will not forget in your life. What is that? They want something in return. they want something in return. I think that's the easiest way that you could imagine why they are considered or they are called investors. For example, like this, right? John, let's say this is a case, right? Let's say you own a hospital, okay? You own a hospital, and suddenly, you know, one day, there's a young guy, and the guy is dying, right? The young boy is dying, and then he collapses in front of your hospital. You can imagine, right? So he collapses, and then you look at the case of this boy. You are thinking that, oh, this boy is like a poor boy, he looks like a beggar. Most likely he cannot afford to pay you, right? But because you are a good guy, right? You have the compassion, you know. You look at the boy and then, okay, I will take him in. So you decide to take him aboard, knowing that he may never be able to pay your hospital, I pay you. But you say, okay, whatever happens, I will try to heal the boy. And if he doesn't pay, then it's okay. I will, yeah, write it off. I'll do the write off. Okay, so you decide to take him in, then you try to heal him, and it turns out to be true. So he's severely ill, but he gets better after 5 days. After 5 days, then he could be discharged, and then you discharge him, and yeah, it's, you know, as you have expected, he cannot pay anything, right? He cannot afford to pay anything. So you let him go away free, no payment, okay? So you write off the transaction. You say to your hospital executive that this never happens, okay? Just write it off, this never happens. But you never know, right? 20 years later, this boy becomes a billionaire. Right? This guy becomes a billionaire. You never know, right? Someone's life, you know, 20 years later, you know, he comes back to you, right? He comes back to your hospital, and then he throws money on your table. So let's say he throws maybe 1 trillion won, 1 trillion wons to your table, and he said, okay, because he almost died in the past, but he was alive because you were compassionate enough to take him in. Now he is very healthy, he's super rich, right? So he threw, let's say he throws 1 trillion wons on your table, but he said this, okay, just use this money for whatever. You can help other children, you can help anyone, but you don't need to give me anything. You don't even need to repay me the money. You see the situation, right? So this boy that is now adult, he give you 1 trillion wons. He says, you don't need to repay the money. You don't need to give him any interest or dividend or anything. So John, simple question to you. Is this guy an investor?
Yeah.
He gives you money for free. For free, he doesn't ask anything in return. He doesn't ask you to repay the money even. Is the guy an investor or not?
No.
No,
Yeah.
no, he's not. That's right. Yeah, that's right. So he's not an investor. Why? Because he doesn't ask anything in return. That's why now if I rephrase my question again to Songwoo, why are they called investors? The easiest way to imagine this is that they ask something in return. So we can prove it, right? We can prove it. That what Jinsu said, creditors. Huni, what do you think, Huni? What are they asking? Creditors? They lend you money and they're asking for what?
Creditors, if a company issues bond.
So what are they asking? What do they want from you? So they give
The
you money, they
bonds,
give you lending.
bonds rate.
Yeah, that's right. Very good. So they're asking for interest. So we have to pay interest, right? Common sense. And then the next one, oh, I cannot read the alphabet. Ko, are you there? Oh, Ko is driving. Okay, I'll skip this one first. Okay. Taewong, are you there? Taewong? Lock, are you there? Lock?
Yes, I'm here.
Who is it?
Yeah, Lộc.
Oh, Lock. Okay. So
Yes.
what are stockholders asking? What are they asking in return if they invest?
they asking for the dividend.
Dividend, that's right. So you see the proof, right? So we have proved it. You see, why are they called investors? Because they want something in return. We have proved it, right? Creditors ask for interest income, right? To us, this is interest payment, and stockholders ask for dividend income. Okay, so that's why they are called investors, because they want something in return. Okay, so now it becomes very easy. So if I say why there is a cost of capital, okay, cost of capital, because the capital that we employ is not free. Okay? The capital that we employ is not free because it has a cost. So why does it have a cost? Because the suppliers of capital are not giving the money to us for free. Different from the, what's that? The example with John. Right? John is the owner of the hospital, but in the future, the previous patient is giving him 1 trillion wons without any request. So that guy is not an investor because it's free guy. But again, the capital that we employ is not free. So it has a cost. Why is that so? Because the capital is supplied by people who want something in return. So this is very easy, right? So what is cost of capital then? To us as a company, this is the cost of capital. But what is it actually? This is the required return by investors. So you see the analogy, right? Now it's very easy to imagine. This is the cost of capital to us. We are the company. So what is the cost of capital? So cost of capital is actually the required return by investors, because capital is supplied by investors. Okay, now if I talk about the components, what is the first component here? Creditors, right? Creditors. So I have cost of debt. Cost of debt. So what is it? Maybe I have to go back to Sungwoo again. So Sungwoo, if I say a cost of capital means the required return by investors. So this is the first component here, cost of debt. So debt is supplied by creditors. So what is cost of debt then? What do you think, Sungwoo? What is debt? So required return by who?
I think payment for bond.
Yes. So
Yeah.
required return by creditors.
Bond.
Yeah, bondholders, banks, bondholders, everything. Yeah, so we call it creditor, right? So required return by creditors. That's why, like what Sungwoo said, right? If I want to know my cost of debt, for example, if I have a project, okay, what is the cost of debt? So there's a easiest way. Easiest way is ask the bank. Okay? So Sungwoo, you can just ask your bank, right? So I want to borrow. Let's say I want to borrow 1 trillion wons. I want to borrow 1 trillion wons. How much interest will you charge me? How much is the interest rate if I borrow 1 trillion wons from you or from your the syndicate of banks? So for example, the bank says 5%. Then 5% is the cost of debt. Right? It's the
Maybe
cost of debt.
4%. Yeah, in Korea.
Yeah, 4% in Korea. Okay, yeah, 4%. So if you ask the bank, so if I want to again borrow money for this project, how much is the interest rate? And the bank says 4%. Then 4% is the cost of debt. Very easy, very easy. But there's a more difficult way. You see, Sungwoo, why you are reluctant to do the first method. So first method here is asking, right? Just ask the bank, right? Asking a bank. This is the easiest way. But there's a possibility that Sungwoo is reluctant to do that because maybe the project is confidential, secret, okay? So Sungwoo doesn't want to tell anyone, including the bank. Of course, the bank, for example, Nathan, you're the bank, right? So if Sungwoo comes to you and Sungwoo is saying to you, I want to borrow 1 trillion wons. How much is the interest rate? But Sungwoo says, so Sungwoo warns Nathan, okay? Don't tell anyone, okay? Because you are under oath. Right? If you're a banker, you have the banker ethics, the code of ethics. of bankers. If you have a client, you have to keep the information confidential. But you never know, right? You never know, because Nathan will go home, Nathan will tell his wife, okay? And then his wife will meet her friends in the market, in the supermarket, anything, and they will talk, right? So, oh, it's a Sungwook's company, you know, Sungwook's company has a new project. So he just met my husband yesterday. He wanted to borrow 1 trillion won. So, you know, women are talkative, right? So Nathan's wife might meet with whoever here, Yumi or other friends, and then they start talking about it, right? You understand what I'm saying? So Sungwook doesn't want that to happen because it's, the project is so good, confidential. So maybe you choose the second way. Second way, like what actually Sungwook said before, you try to calculate the yield to maturity of another bond. So today we are not going to see the calculation of this, okay? You just need to watch my video, okay? I explained it there also. So here's another possibility, okay? So this method is more tiring, maybe less accurate, but more confidential, more secretive. So you don't need to tell anyone. So you secretly estimate the yield to maturity of another bond. For example, you see another company or another project that has issued a bond. So the bond has the maturity of maybe 20 years. It has a certain coupon rate, okay? Then you can calculate the yield to maturity. I'm sure in your life, you experienced this, or maybe in your corporate finance lesson before, corporate lessons course, okay? So the second method is more tiring, maybe less accurate as well, but it's secret, more confidential. Nobody knows what you are calculating, right? So it's safer. But of course, the first method is more, it's easier and also more accurate. Because it's very easy, right? You just go to a bank and then give the proposal. You give the proposal to Nathan and then, okay, Nathan, how much will you charge me? And Nathan will analyze with his team, and Nathan will give answer within maybe 1 week. Very easy, right? Very easy. But the second way, yeah, could be more secretive. Okay, so this is cost of debt. And I think if you have learned, or maybe in your real life, the cost of debt should be what? Cut by tax. Okay, this is tax deductible, because the higher the interest expense that you pay, the lower your taxable income and the lower your tax payment, right? So cost of debt is tax deductible, right? We're not going too far about this because I think you have learned about it, and also, yeah, maybe you have done it in your life as well. So this is tax deductible because interest expense could lower your tax payment. Okay, and then now let me continue, Nathan. So if I say cost of equity, what is it? You see the analogy here. Cost of capital is the total. So we say this is the required return by investors. So if I talk about the first component, cost of debt, this is the required return by creditors. So what is cost of equity then? Required return by who? Can you see the analogy here? If I talk about debt, cost of debt, this is a required return by creditors. So if I talk about cost of equity, then what is it? Required return by who? Nathan, what do you think?
Investors?
But which one? Which investors? Because investors is the total. The total is investors. So debt is creditors, supplied by creditors. What about equity? Who is it? Anyone maybe? Who is it? The other guy?
Stakeholders.
Stockholders.
Yes,
Stockholders. Yeah, stockholders. Yes. Stockholders, or you can call it owners if you want. Owners of the firm, right? Owners are stockholders. So again, if you see the logic here, cost of debt, right? Debt is the required return by creditors. So cost of equity is the required return by stockholders. So in total, the total is cost of capital, right? Cost of capital, the total. Then the cost of capital is the required return by investors, right? Because investors are the total, right? Included in the investors are creditors and stockholders. Okay, so you understand what I'm saying, right? So this is a very easy concept, right? Why do we have a cost of capital? Because the capital is supplied by people who want something in return, and we have proved it, right? We have proved it. So then what is cost of debt? Cost of debt is the first component. So cost of debt is the required return by creditors. And then the second component here is the cost of equity. So cost of equity is the required return by stockholders. So in total, we call it what? Cost of capital, right? So cost of equity, how do you usually estimate this in real life? You use the capital asset pricing model. Capital asset pricing model, right? I hope you still remember. CAPM, we call it CAPM, Capital Asset Pricing Model by William Sharpe. So you see here, required return by stockholders, required return by stockholders should be the function of risk-free rate. Risk-free rate, still remember risk-free rate? What is the risk-free rate in Korea? What do you think? Risk-free? What is the risk-free rate in Korea? What do you think? What interest rate is it? What kind of interest rate that is considered risk-free in Korea? Any idea?
Treasury bond.
A treasury bond? You call it treasury bond also in Korea? Okay, yeah, good. Yeah, that's the American terminology as well. So treasury in the US we have T-bill and then T-note and T-bond. T-bill is the short-term one. T-bond is the long-term one. T-note is the intermediate. So yeah, T-bill or treasury bond rate. How much is it in Korea? Can you tell us, Moon? The risk-free rate?
Under 1
0.88%.
Or 0.88%. Yeah, that makes sense. That's right. So about 0.8%. So you have risk-free rate. Of course, maybe we discussed it a bit in the previous weeks. Actually, we cannot really guarantee that a country cannot go broke. Right? I mean, if I rephrase my question, can a country or a central bank go broke? Of course, the answer is yes. Right? That's possible, and we have seen the examples like Greece. Okay, Greece, and that maybe the next one will be Spain, Italy. We know those countries are not that healthy financially. We know that. So Greece has collapsed before, but you see the logic here. The government has a lot of methods or a lot of ways to get quick money if they are they have difficulties, right? So suddenly, if a government has liquidity problem, it needs quick money, the government can do anything, right? Can do many things. Can you give me some examples? If a government has a dire need for money, what can a government do again? What can they do to get quick money? Maybe, is it Huni, what do you think? Huni, if a government needs quick money, what can they do? They don't have money, but they need quick money. What can they do?
They issues the government bonds.
Yeah, it can borrow money again, right? Can borrow more money by issuing government bonds. What else?
Maybe they can print the money.
Yeah, that's even more dangerous but easiest. Yeah, right? Very dangerous but easiest because that would create a hyperinflation. But yeah, who cares, right? They need quick money. They could print more money. They just need to go to the history books. You understand what I'm saying, right? They'll get a history book and look for what? Look for the heroes that have not been used for printing money. You understand what I'm saying, right? So you look at the pictures. Oh, the previous kings or yeah, anything. Okay, we use this guy to print the money, right? For the face. the picture of the money. So very easy, right? Dangerous but easy. Maybe one more. Any idea? Any of you? What else can they do? They can borrow more money by issuing bonds. They can print more money. Dangerous but very easy. What else? One more maybe.
Increase the tax rate.
Yeah, that's even painful one, but yeah, possible. and the citizens will get angry, right? Get angry and do the demonstration and everything, but it's possible. So increase the tax rate. Yeah, many other things they can do. They can sell islands if necessary, right? I know it's not good, but it's possible to sell islands. You see what the USSR did in the past? They sold Alaska. They sold Alaska to the United States, or something like that. So anything could happen. So that's why we call it risk-free rate. Actually, it's not really risk-free, but at least we know that if the government has, again, the dire need for money, they could print money, they could do anything to get quick money. Right? So plus, we have we call it risk premium, right? Market return. So market return, this is also difficult to define, but to be pragmatic, we usually use the proxy of market index return. Market index return, for example, the return of Kospi return, not the Kospi, but the return on the Kospi index. So return on Kospi index, return on S&P 500, return on Straits Times index in Singapore. We call it Straits Times. Right? So return on a market index minus risk-free. So we call it what? We call it here risk premium. Risk premium or excess return. You can call it an excess return as well. Yeah, whatever you want to call it, right? It's risk premium. And then risk premium will be multiplied with beta. I hope you still remember from your corporate finance course, maybe corporate finance course or investments course about beta, beta of the investment or the stock, right? So beta is the sensitivity, the sensitivity to the market. Okay, I hope you still remember. How do you get beta? How do you get beta? You have to do a regression. Regression, for example, we have the historical return on Samsung, maybe. Okay, we have the historical return on Samsung, maybe for the last 5 years. Okay, for the last 5 years, so we have the data back there. Okay, and then yeah, you could regress it immediately on maybe Kospi, right? Or you can use different style here if you want, but I know it might be not that relevant for now to know, but it's about the econometrics part, but maybe suffice it for now to do it this way, okay? So you can regress it on the historical return on Kospi, or yeah, any index that you want. Then you get what? This is regression, right? Okay, so you get the alpha, okay? You get the alpha, and then you get the beta, right? Okay, you get the beta, and of course you get the error. You get the error. Okay, so you get here's the beta. So it's what's that? The coefficient, right? Coefficient of regression. So how to interpret this is very easy. If I tell you that the beta, let's say beta of Samsung is, let's say 0.8. What does it mean here? 0.8. It means that if Kospi increases by 10%, Samsung will increase by 8%. You understand what I'm saying, right? So if the beta is 0.8, it means that the sensitivity is 0.8. So if the market increases by 10%, then Samsung will increase by 8%. So let me try Yumi. Okay, Yumi, if I tell you that the beta is, let's say 1.2, okay? If the beta is 1.2, then if Kospi increases by 10%, what will happen to this company?
12%? 12%.
Yeah, very good, excellent. Yeah, excellent. Yes. So one more try, right? One more try. Lady, I don't know your name in Roman alphabet, so I cannot call you. But Jinsu, okay, Jinsu, if the beta is minus, let's say minus 0.9, and if the Kospi is increasing by 10%, what will happen to this security?
9%.
Jinsu, what do you think? Kospi is increasing by 10%. What will happen to Samsung if its beta is minus 0.9?
9%.
Yeah, but be careful. This is minus.
Yeah.
So
Minus.
yeah, minus 9. Okay, be careful. The beta is minus 0.9. Right. So if Kospi increases by 10%, so Samsung will decrease by 9%, because you see the sign here. Be careful. Right? The sign. Right? The previous example was positive here, positive, but this one is negative. Be careful, right? So minus 0.9. So we understand now the concept of beta. Of course, beta is a big topic of itself. Right? So we will not be able to discuss beta in 2 hours. So again, beta is the sensitivity to the market. How to determine beta? We do the regression, right? See, regression of the security return. In this case, Samsung, a previous return on Samsung, we regress it on the previous return on Kospi. Then we get the alpha and the beta and error. So we get the beta here. Okay, so this is called CAPM, Capital Asset Pricing Model by William Sharpe. Okay, the legendary CAPM. Remember that we will use this always in every project that we are doing. I know in your business, in your company, and also in my business also, the valuation technique or anything, we always use CAPM. So CAPM, you see here, what is it again? Required return by stockholders. Required return by stockholders is the cost of equity. I understand. So the logic, right? You see the logic. So I try to summarize everything, okay, before we see the international context. Why do we need to estimate the cost of capital? Because the capital that we employ is not free. The capital is supplied by people who want something in return. Right? Who are they? First one, the creditors. Required return by creditors, something they want, something they ask for, is the cost of debt to us. The cost of debt is the required return by creditors. And how to estimate it again? Like what Jinsu said before, asking a bank or yield to maturity of another bond, you can estimate this easily using Excel. And the second component is the cost of equity. So what is the cost of equity again? Required return by stockholders. So in total, we call it what? Cost of capital. So if I write it like this, cost of capital would be what? Cost of debt, right? Be careful, cost of debt is tax deductible, okay? Remember, cost of debt is tax deductible because interest expense could lower our tax payment, right? Plus cost of equity. So before we add them together, cost of debt plus cost of equity, we have to multiply each with its respective weight. For example, how much proportion of the equity? For example, in our capital structure, we are using 50% debt, 50% equity, or 60% debt, 60% equity. I think in East Asia, the debt financing is quite intensive, right? In East Asia, like Korea, Japan, and China, we like to use borrowing, right? Especially because the borrowing comes from the conglomerate holding. For example, if you talk about Samsung of course has the car manufacturing facilities. It has also mobile phone producer. It has a bank, I'm sure, very similar to the case in China, in Japan as well. Right? They call it what's that? Conglomeration is a keiretsu in Japan. Maybe in Korea, what do you call it? Chaebol or something? Some names like that. I think you're quite familiar with the name. Yeah, with conglomeration company. So that's why we like to use borrowing. So it depends on the country. But see, maybe you use 50-50 or 60-40 or 70-30 or anything. Right? So we have the weight. Because we add the cost of debt and cost of equity by considering the weight, that's why we call it what? Weighted average. So weighted average cost of capital. Because this is weighted by the proportion. I weighted average cost of capital by combining the cost of debt and cost of equity. Any question about this? I hope you understand this. This is the core of the cost of capital before we see the international context. So cost of capital, this cost of debt plus the cost of equity. And if you have preferred stock, maybe you add the cost of preferred stock as well, weighted by each proportion of debt and equity and something like that. This is why we call it weighted average cost of capital. Feel free if you have questions, okay? So we'll go to the international context now. Now, the situation is complicated with the international context. So if we go to another country, now we have other considerations, right? We'll start with the cost of equity. So remember here, cost of equity required return by stockholders. Right? Cost of equity is a required return by stockholders. So cost of equity, and usually we use CAPM. We just talked about it. So remember, so the required return by stockholders should equal risk-free plus risk premium. Risk premium is the market return minus risk-free, okay? Then we multiply it with the beta of the security, right? Beta of the company. Yeah, we also have this, have the formula here. Now, there's systematic and non-systematic and unsystematic risk. Then we could see the beta here. We just talked about it. So remember, what is it again? Beta? Sensitivity to the market. Sensitivity to the market. So let me ask from Tae Wong, are you there? Tae Wong? Tae Wong is not there yet. I don't know your the pronunciation of the name. So I'll go back to Nathan now. Nathan. So we just talked about beta. Beta is the sensitivity to the market. So what risk is it? Systematic or unsystematic? If you know that beta is the sensitivity to the market. So is it systematic or unsystematic? What do you think, Nathan? Is it systematic or unsystematic? The beta.
I'm not sure, but I think it's systematic.
Yeah, that's right. It's systematic. It's very easy to imagine because now beta is the sensitivity to the market. And market means everyone in the market will suffer from the same risk. That's why we call it systematic risk. Right? System, member system means everyone in the system, everyone in Korea will suffer from the same type of risk. For example, the inflation risk. Right? If inflation rate in Korea is something, then all people in Korea will suffer from the same inflation risk, interest rate risk, exchange rate risk. We talked about this a little bit in the past. Political risk, okay, something like that. So beta is obviously the systematic risk because beta is the sensitivity to the market. So how to estimate beta? We see here. So beta of let's say security, one security, okay, one asset is what? The risk of the asset divided by the risk of the market. Risk is the standard deviation, right? The risk of the market multiplied by the correlation between that asset and the market. Okay, so that's why beta is the sensitivity to the market, right? It's the regression coefficient that we just saw some minutes ago. But if you want to calculate it, want to estimate it manually, this would be again the risk of the asset, risk of the asset divided by the risk of the market multiplied by the correlation between the asset and the market. That's why we call it the sensitivity of that asset's return to the market return, or simply you can call it sensitivity to the market. So again, this is systematic risk, and now we have a lot of issues here. So actually, if we talk about the cost of capital, right, what we have learned in the corporate finance course is actually or is full of generalization. Okay, generalization means it holds to average cases, but actually some of them are not really specific, not really pragmatic. So let me give an illustration. Okay, Moon, let's say you have a company, Moon. Your company has a lot of projects, right? And then you calculate the cost of capital of your company, and you find out that the cost of capital of your company in as a whole is, let's say, 7%. Right? The cost of capital of your company, right, Moon. However, if you have many projects, you have project number one. Project number one might be in the mining, okay, mining industry. You have project number two. Project number two is doing the maybe fashion, right? Project number three, you have a project in maybe service, like hotel, restaurant, or anything, and many other projects. So actually, for every project, you have to estimate its own cost of capital. You understand what I'm saying, right? So it's not really appropriate to use the cost of capital of the company to represent the cost of capital of every project. Not that accurate, unless you know that the project is really, really typical, really general. For example, you have a whatever simple project that is very similar to the headquarters of the company. But if you if the holding, if your company as a holding has so many projects and they are all so different, then you cannot use the cost of capital of your company as a whole to represent the cost of capital of every project. Not suitable, not accurate, right? So you have to estimate the cost of capital of every project. Right, of every project. So if you have this different project, then you have to estimate its own cost of capital. Then everything would be very different between one project to another, because the cost of capital require. Still remember, cost of capital, we have components, right? Cost of debt, we have cost of equity, and the cost of equity is this, the cap M. So the beta for the project will be different. The calculation for risk premium will be different, and this one may be the same. Risk-free will be the same for every project, because we live in Korea. You can imagine that whatever projects we are doing in Korea will have the same risk-free rate in Korea, for sure. But the other components will be different, right? The risk premium, the beta, of course, might be different. So now we know that project beta is super important at project beta, because every project should have its own beta, and consequently its own cost of equity, and consequently the cost of capital. So project specific. So let's talk about this now. Imagine we are estimating the WACC. So remember this one? We just talked about it. Weighted average cost of capital for foreign projects. So let's say the L is the, what's that? Debt ratio, parents debt ratio. Okay, parents debt ratio. So we have here debt ratio. So this is the proportion of debt, right? Proportion of liabilities. Let's say this is 50% or 60% or whatever. Cost of debt will be multiplied by, the proportion of debt, proportion of liabilities will be multiplied with the cost of debt. Oh, they use K, okay? Previously, I used D or R. So it doesn't matter, okay? Whatever notation you want to use, but you understand that this is the cost of debt. I use R, the textbook uses K, but it's okay. And remember, cost of debt is tax deductible, right? Tax deductible. So this is what? What is it again? Cost of debt, right? This is the cost of debt. And what about the cost of equity? Cost of equity is, of course, this is the proportion of equity. 1 minus proportion of debt. We know that, in the on our balance sheet, in the capital structure, we use debt and equity. So if L is the proportion of liabilities, 1 minus L will be the proportion of equity. So proportion of equity multiplied with the cost of equity. So this is what the equity part, equity, cost of equity. So cost of equity plus cost of debt. So we get the cost of capital. Okay, so here again, the big headache here is when we deal with international context, now we need to decide each component, right? Each component. When we go international, how much is the proportion of debt? How much is the proportion of equity? And then what will be the cost of debt for that particular project overseas? If you're a Korean company, if you go to Vietnam, of course, we have to estimate the cost of capital, and cost of capital consists of cost of debt and cost of equity. So we have to determine each input. So the calculation itself is easy, right? You can see, right, throughout our course, we are almost done with our course, but you know that throughout our course, you have seen that we can easily calculate everything using Excel or other software packages. Wouldn't be a problem. But the main problem here is how to determine the inputs to each formula, right? So let's see this one example first, okay? 60% equity and 40% debt. Okay, so what would be the cost of capital? So 60% multiplied by this one, right? 60%, and the cost of equity is 14, cost of debt is 6. So this is the proportion of equity at 60% multiplied with the cost of equity, and then the 40% proportion of debt multiplied by the cost of debt. So we get what? Cost of capital of here. This is the result, 10.8%. So again, the calculation is always easy, but how to determine the input will be, I think, the most challenging one. Okay, now we start each of them. Again, we start with the cost of equity. Equity, we are talking about the cost of equity, the first part here. Okay, so first one, okay? First decision, what beta should we use? Okay, which beta should we use? Let me, yeah, here, okay. So here's the basic idea. If you go international, it may seem that we go to riskier country, more dangerous country. Of course, why do you go there? It's very easy again, right? If I ask, maybe I ask again to make sure. Okay, Ko, yeah, you are there, Ko. Ko, you're a Korean company, okay? You're a Korean company, and you decide to go to Vietnam, okay? You go to Vietnam to produce something, to sell something. Let me ask you a very quick question, okay? Why do you want to go there? What makes you go there? Take your time, take your effort to go to Vietnam to produce something, to sell something. What do you think, Ko? If you're a Korean company, why do you want to go to Vietnam to produce and sell things? Yeah, Ko, any idea? You're a Korean company, you decide to go to Vietnam. Why do you want to do that?
I don't know.
Just common sense. I mean, if you have a business, you have a business, you're a Korean company, you decide to go to Vietnam, why? Yeah, why? It's up to you. Why do you want to go there?
A Korean company?
Yeah, you're a Korean company. You
Yeah.
decide to go to Vietnam to produce something, to sell something. Why is that so? Why do you want to do that?
Low cost.
Hmm?
Low cost.
Yeah, low cost. Hmm?
Yeah. Low.
Yeah, that's correct. Low cost.
Yeah.
Yeah, you could have low cost production. And I think if I could summarize in one phrase, this is the phrase, right? Make more money. Okay, very easy, right, Cole? It's not not something spectacular. You know? Why do you want to go there? You want to make more money, right? Maybe because the market in Korea is tougher and everything, so you want to make more money in Vietnam and everywhere else. So this is the concept of portfolio, right? That we talked about last week. So if you go to now, if you go to a very developed country like America or Germany or something like that, one thing there is the competition is tougher, but secondly, the correlation between the Korean market and the developed country might be high. The correlation is high. So if the correlation is high, you don't get much benefit from the diversification. You see, remember our discussion last week, right? The correlation is very important, right? Very important concept in portfolio, because again, if you go to developed countries, it might seem that they are very safe, the certainty is higher, risk is lower. However, the correlation might be too high, making you making you not gain much from the diversification. Right? Again, we come back to John. Okay, John, if you invest in America, you know that again the certainty is high, the risk is low, everything is more certain, but the correlation with the Korean market is pretty high. Right? The correlation is high means that whatever is happening there might happen here at the same time. Whatever is happening here might happen there at the same time. So you don't get much benefit from diversification. So it's very different, John. If John decides to invest in, let's say, in Algeria or Sudan, for example, Sudan, we know that Sudan is definitely riskier than America, for sure. Everyone knows about it. But you see, if we invest in Sudan, the correlation might be quite low because it's not a famous market. You know, it's quite segregated. In Africa, it's far away. So what is happening here might not happen there at the same time. And what is happening there might not happen in Korea at the same time. So the correlation between the two markets might be low. If the correlation is low, you get more benefit from diversification. I imagine from the portfolio theory that you learned before, right? So even if we go to, you see, if you go to like less developed countries, maybe you go to Laos, you go to Cambodia, you go to Vanuatu, Fiji, or anywhere. So they might seem riskier. That's true, right? They are riskier. Uncertainty is high. Political risk is also high. But if you think about the portfolio formation, you have your base in Korea, you have the headquarters in Korea, but you invest in such countries. They are riskier, But when you combine into one perspective, actually your portfolio is getting better. Why? Because you add countries with lower correlation with Korea. Okay, so this is quite a different concept. If you do it individually, they look very risky. But if you treat them, you consider them as part of the portfolio, then actually your portfolio gets better because their correlation with the Korean market is lower. Okay, so now we have some questions to answer. The issues here. So should the corporate proxies be this is US textbook, right? But you can imagine this is Korea. Korea or local? Korea or local? Local means what? Cambodia, Sudan, Zimbabwe, whatever at the local. And this is home. Your home is of course Korean market. Korean market is our home. But the local markets are everywhere. So which one should be the proxy? And then what is the relevant base of the portfolio? And what is the risk premium? Okay, so we will answer one by one, okay? What question is it? This question is actually about the cost of equity. What is it again? Cost of equity is risk-free plus risk premium multiplied by beta of the security. So remember, we just saw it, right? So we have to decide one by one. That's why when we talked about it some minutes ago, we talked about the corporate finance in Korea. So we don't have any, we don't have any problem because we know, oh, this is the risk-free of the country of Korea. You just told me 0.88%. That's the T-bill rate in Korea. And then what is the beta here? The beta would be the regression between Samsung and Kospi. Samsung return and Kospi return. Very easy, right? Very easy. And what is it? What is the market return? This is return on Kospi. This is return on Kospi. And then, of course, this is the risk-free again, the T-bill, Korean T-bill. This is Korean T-bill. And then this is the regression between. So the sensitivity of the Samsung sensitivity of Samsung to the market. So it's very easy. But if you go international, now you have questions to answer, right? A question to answer. So what RF should you use? Now we start from the first one. So there are a lot of possibilities. But what do you think? So we have the home market. Home market is Korea. Then the local market could be Zimbabwe or anything. Yeah, John, please.
Yeah, I think the who is located in the investor is located in where, I think. Maybe it is it is the different from the risk premium. I think maybe I think maybe the who how can I say, and what country is in located needed it to the risk premium or the return, I think.
Right. That's yeah, that's good idea, good perspective, John, because actually that's the big question that we have to answer one by one, right? So we have to decide, right, what risk free to use, what risk premium, and everything later. But firstly, let's start from RF. Any idea which RF should we use? Let's suppose that we are a Korean company, right? You can imagine we are Hyundai or a bank, right? Certain bank or Samsung or LG or anything. Let's say we are LG, okay? LG, most of our investors are Koreans, for sure. The stockholders are Koreans. Also the creditors, most of the creditors are Koreans. Of course, there's some creditors who are Americans, who are Singaporeans, everything, but mostly Korean. So which risk-free should you use? The Korean version or the local? Any idea? Because each choice, each alternative has its advantages and also disadvantages. So we are not saying that this is the correct one, that is the wrong one, okay? We're just seeing alternative, right? How we define each of them. Any idea? We start from this one, risk-free. Or Tae Wong, are you there? Tae Wong, still not there? Log maybe?
Yes.
What do you think about the risk-free? If our home market is Korea, we could use the Korean risk-free, or we could use the local risk-free. What do you think? I mean, there's no right and wrong, okay? Because each alternative has its own advantages and also disadvantages, of course.
Yeah, but what do you mean when you mention about local?
Local means, for example, if we are a Korean company, we go to, let's say we go to Cambodia, okay? So home risk-free will be Korean risk-free, and the local risk-free will be the Cambodian risk-free rate. What do you think?
I think it's risk-free is based on the local market.
Why is that so? Why do you think so?
Because it have the business in the local market, so it's affected by the market where they have. Yeah, I think so.
Yeah, very good observation, Lok. Thank you. So yeah, actually, I think maybe all of us could agree with that statement, okay? Especially if the investment if the investment is supplied by mostly the local investors, you could imagine like I think not the case for LG, Samsung. We cannot use that case here because the investors are mostly Korean, right? Imagine what I'm saying, right? LG, Lotte. Lotte is Korean company, right? Yeah. So something like that. LG, Samsung, Lotte, Hyundai, or everything. So we know that mostly the investors are Korean, and then we go somewhere else. But let me use another example. Maybe the General Motors. Okay, General Motors from America. When they go to China, you know what I mean, right? Chinese market is complicated because the country is not capitalistic country. It's unlike Korea or America or Singapore. Everything we are capitalistic, in nature. But China, they say they are liberal, but no, not really, because we have to deal a lot with the government. So to make it easier to do business there, usually we will make a joint venture with the local company. For example, General Motors has a Wuling Shanghai Corporation, okay? So 40% owned by General Motors and 60% owned by Shanghai Motor or something like that. Shanghai Motor. Okay, now you see the situation. When we go somewhere, the joint venture is supplied most by the local investors. Then what Lok said would be more appropriate, to use the local RF. However, in the case of like LG, Samsung, and everything, remember that our investors are mostly Korean, mostly Koreans. So I would say that maybe it's more appropriate to use the Korean RF in that case. Okay, Lok, do you agree with this? Right? If you are saying that if I go to China, I have to make a joint venture with the local companies, and we find out that the local companies actually have a share of like 60%, even more than we do, then I think maybe the local RF might be more appropriate. But in the case of like Samsung, LG, we just go somewhere to sell something, to produce something, but actually most of the investors are the home people. Then maybe we have to use the RF, the home RF, or the Korean RF. It's debatable. That's why I'm saying that we cannot decide, right? This is wrong, this is right. But we need argument, okay? You see how the arguments are the key, okay? Not the calculation, because the calculation will be easy, right? If you know, okay, I want to use this RF, I want to use this beta, and then you put into calculation, then yeah, you could calculate easily. That's not a problem. But the key is the input, right? How you define the input, how you interpret which RF is it, and each of them. Any question about RF before we see now the beta, this component? Quite clear, right? RF, I would suggest for a Korean company like LG, Samsung, anything, it's better to use the home RF, the Korean RF. Korean is free, right? Because it has a stronger context than the joint venture. So now, question about beta. Yeah, this is a big headache one, right? Because, so what is the combination now? See? So when we estimate beta, remember, we have the return on the asset. So your asset is the project, right? The project. If you do a project in, again, you do a project in Cambodia. So do you have the historical return? Maybe not. Most likely not, because you just go there. How do you get a historical return if you just go there? Right? Nothing, right? So you have to use a proxy. So you have to use a representation. You just go to Cambodia and you have a, let me give you an example. Maybe waste management, waste management project. This is good money, okay? I don't know whether you ever work for this kind of company, waste management. This is really good money in a developing country. You can do use a lot of technologies, the RDF and everything, and you make a lot of money in that country. But again, you don't have the historical returns because you just go there. Then you have to use a proxy. You have to borrow. Right? You have to borrow. Now the question is, what company should you borrow? Right? Is it a Korean company, home company, Korean similar company, or we should use the Cambodian company as the proxy? Okay, so see again, question now starts coming up. Which one should you use? Can you tell us quickly? I mean, actually, we have it in the slides if you want to see. Okay, if we use local companies, yeah, this is so true. This first statement, you see, this statement summarizes everything. As much as possible, the corporate proxy should be the local company, okay? Because, or let me ask, let me go back to Moon. Let me go back to Moon. So as much as possible, we try to use the corporate, I said the local proxy for this one. That we don't have the historical return, so we have to borrow, we have to use a proxy. So as much as possible, use the local company. What is the weakness or disadvantage of using the home company? What is the weakness of using the home company then?
Yeah. Between home and local companies, there are a lot of.
Yeah, what if we use a home company, what is their weakness? Because now you see, based on what we just saw, see the first point here, as much as possible, the corporate proxy should be the local companies. Why is it less desirable compared to the local company? Local company means the Cambodian company or Zimbabwean company or something. Why shouldn't we choose this one?
I think there is a big difference between home and local company. But I don't know, that's the one.
Yeah, I think that's about right. So if we use the home company, I think the situation might be too different, right? Especially if you go to a less developed country. If you go to the less developed country compared to Korean environment, Korean corporate situation, I think it's totally different. So it might be less representative. That's why, right? The company proxy, we try to use as much as possible the local company. Local company means the Cambodian company or Zimbabwean company. But if it doesn't exist, there's a big headache there. Okay, so I'll give you an example. Okay, let's say you in Korea we have the high-speed train, right? High-speed train that will travel very fast, maybe from Seoul to Busan in 2.5 hours or something like that, right? To the high-speed one. So let's say you go to Indonesia, okay? So you're going to sell the high-speed railway, high-speed train to Indonesia. So you see, right? We just saw that, okay, what is the beta of the project? So to get the beta, first you have to determine this one. And of course, we don't have any historical return of doing the high-speed train in Indonesia, so we cannot use it. Now you have the best alternative according to the textbook that we just saw it. The best alternative is to use the local company. But what local company that exists? High-speed train in Indonesia, not existing. That's why we go there. You understand what I'm saying, right? It doesn't exist. So if we don't have this one, then we have to use the Korean one. We have no other choice. Okay? So we can use, yeah, actually you have other choices. For example, you can borrow the return on high-speed train in maybe in Malaysia or in Thailand, right? The nearby country, neighboring countries, nearby countries. But again, it might not be that accurate. So you might end up using this one, okay, the Korean proxy, because you don't have this. Right? Understand what I'm saying, right? In some situations, you don't even have this one. You go there, there's no high-speed train. So what can you borrow? No data could be borrowed because they don't even have, so far, they don't have a high-speed train. So we have to borrow from maybe neighboring countries' data or use our own data, the Korean company, because we already have the high-speed train in Korea, and then we are selling the technology to Indonesia. Okay, so you understand what I'm saying? So if we decide to use that one, then you can make adjustment actually. Here, this is the adjustment. So the foreign market beta would be, this is just a market, okay, not really, we're not really talking about the security. So yeah, might not be that accurate. So the standard deviation of the foreign market, the local, right, the local, divided by the standard deviation of the home, the Korean, multiplied by the correlation between the foreign and home. So we get the beta of the foreign market. Beta of the foreign market, but not really similar to our discussion, okay? Because our discussion tries to determine the beta of the project, not the beta of the foreign market. You follow, right? So what we have been talking so far is how to interpret, how to determine the beta of the project and not the market. Okay, so what is the principle again? As much as possible, use the local company return. Okay, use the local company return for this one. However, if the local company return is not existent, then we'd have no choice but to use the home market, the Korean market return. Right? No other choice. Another possibility is this one here. Use the industry, okay? So I know this is quite so many alternatives. Sometimes it creates headaches, but yeah, in business you have to, of course, in business we have to consider all possibilities, and we'll choose the possibilities that give us the best number. Okay, this is the secret. I think we are all in the industry and we know this. Every time we try to estimate something, we try to get an estimate that is beneficial to us, more advantageous to us in terms of the smooth numbers, more profitable numbers to show our clients or to show our investors. So we try to show like nice numbers, of course. That's why we have a lot of alternatives. So if we talk about this, right? So the return, as much as possible, use the local proxy, okay? Local representative or local proxy. If it doesn't exist, then we have to use the home proxy or the Korean company as a proxy. But Another alternative is to use the industry. Use the industry. For example, you go to, again, if you're a Korean company, you have the high-speed technology, high-speed train technology that you want to sell to Indonesia, and you go to Indonesia and you find that there's no company such as this that has existed. So you cannot use the any local proxy. But instead, actually, you see over there they have train industry. Train, right? They have the normal train, the commuter train and everything. Then we can borrow as well if you want. Of course, it's not that accurate, but if you want to do it, yeah, this is of course okay. So you can use the industry here. So you don't use any security return, but you use the industry return. You use the industry historical return. Again, it's not accurate, of course, absolutely not accurate, but rather than nothing, if you think that it's better to use the local industry return rather than using the Korean return, because Korea is our home country, because the home country might be too different from the local market, then you can use the industry return in the local country. If a specific company that offers such business doesn't exist, you can use the industry return, the local industry return, okay? And you can make adjustment if you want by multiplying with the foreign market beta. But again, I don't think this is an appropriate way, okay? This is a simplification. You can do it in exams, but you will not do it in the industry because there's too much simplification that's not really proper for business. Of course, in academic setting, we can use it, but again, in business, we had better use the manual way. Have to determine one by one. Any question about this one? If we may conclude, okay, from the first item here. Again, we need the historical returns. As much as possible, try to use the local company returns. A proxy, okay, proxy means you borrow. As much as possible, use the local company's returns. But if it doesn't exist, then of course you have another alternative. You use the home country's Korean company's return. This is from home country. If this one doesn't exist, then you use the home country. Or you can use the industry return in the whole local country. Because you think that it might be more accurate rather than using the home country's return. The home companies, right? Home companies returns might not be that accurate, so you might decide to use the local industry return. Possible, but maybe not as accurate as the local company returns. Any question about that one before we continue to the second component? So the second component is the regression one. Right? So if we have decided that we will use local company returns, okay, local company returns in Indonesia or in Vietnam or in Sudan or everywhere, then to get the regression, remember, we need this, right? We need the market return. Next question. Which market return will you decide? Is it KOSPI at the home market, or is it Indonesian stock index, the local one, or the Vietnamese stock index, or Cambodian stock index, or anything? So what do you think, Jinsu? Coming back to you. Maybe going somewhere. Taewong, are you there, Taewong? Yeah, who is it? Who is it talking? Yeah. So anyone? which market return should we interpret? The home or the local? Maybe Yumi, any idea? Yumi? Which market return?
Vietnam? Just
Home
Vietnam?
or local?
Local.
Local? Okay. Yeah, could be too. Why is that? What do you think? What makes you choose the local market return?
It's higher than my country.
Actually, if you think that it's higher, that's not a good number, because if it's high, you can imagine, right? If it's high, then the cost of equity at the end will be higher. And remember, cost of equity means required return by stockholders. So we don't like high number actually, right, in terms of number. But remember, like what Locke decided for RF? I think this is very similar case to RF. So if you think that this project, okay, this joint venture, or this project is highly invested by local people, local investors, then I think what you say was right. So it's better to use the local market return. For example, the Vietnamese stock index return, or Indonesian stock index return, or something like that. However, if the project is heavily financed by our home investors, for example, Samsung, LG, or something like that, I think it's more appropriate to use the home market return. Home market return, because when those stockholders invest their money in our project, they're expecting something, right? They're expecting something in return, and I think the best expectation would be what they can get at home. Right? So if they're Korean people, they put the money in our company, and then we go to Vietnam, we go to somewhere else to invest. Then actually the expectation of the local investors, the expectation of the home investors at home, home investors would be the home market return. Because if you ask any Korean person, okay, what do you expect about the market return? And they will answer the KOSPI return. They wouldn't suddenly say Vietnamese stock index return. So it's quite quite hard to imagine. Right? So if you ask a Korean or the Korean people, what is your expectation about the market? And of course they will say the expectation is about the KOSPI return, because this is a home market. So again, it depends on the situation. We cannot say that this is right, that is wrong. It depends on the case. But again, if the project is heavily financed by home investors, then it's better to use the home market return, like KOSPI or something like KOSPI return. But if the project has a lot of shareholding or ownership by the local investors and local stockholders, then I think it's more appropriate to use the local market return. Okay, so if we summarize this, so what is our summary here? For this one, it's better to use the local company proxy, local company representative, right, for the historical return. But for this one, it's better to use the home market return if our stockholders are mostly home people, right, the Korean people. Okay, you see the difference there. There are other alternatives. You can say, oh, maybe I should use the global one, global market return. Yeah, possible as well, especially if you go to somewhere, hard to say. I mean, it depends on what you want, but if you go to somewhere and you produce something that could be sold everywhere, you understand what I mean? For example, in the past, General Motors went to Thailand. Now they quit already, but they went to Thailand. They made a lot of cars that they sold to the whole Asia. Also Korea, I think, right? What's that? The General Motors, quite famous, big factory in Korea, also in Thailand. So that's the basis of production. So from the production in Korea and then in Thailand, they sell to the whole Asia, right? To the whole Asia. So they might say, okay, our market is not our project is not really tied to Korea, not really tied to America, but it's tied to the global market because we'll sell the products to the whole Asia. So they might want to use the global market as the basis. Yeah, but again, it's up to you. Okay, it's up to you. As long as you have arguments. Okay, so this course or our discussion here in the class shows you a lot of alternatives, right? A lot of perspectives. So we are not saying that this is wrong, this is right, or everything. But see here, based on our logic so far, this one is better to use the local company, but for this one, it's better to use the home market return. So you regress it, right? You regress it. Let's say this is the local company proxy, okay, representative. You regress it on the home market return, like COSPI return, and then you get what? You get the beta. You get the beta of the project, right? How do you get the beta of the project again? By regressing the local company's returns, historical returns, a local company's historical returns that functions as a representative, and the historical market returns from home, from Korean market returns. Right? You regress it, and then you get the beta of the project, right? Beta of the project. Okay, now you get everything. Okay, remember you have this is what's that again? Required return by stockholders. Can you tell me quickly again, Songwoo? Required return by stockholders is, what is it? Cost of what?
Cost of equity.
Required return by stockholders. Excellent, cost of equity, right? So we have seen that this RF, we decided, right, it's better to use the home RF if most of the stockholders are Korean people, right? Plus RM, it's better to use the home RM. Remember, home RM, and then home RF. So essentially, we are saying that it's better to use the home risk premium, especially if our stockholders are mostly Korean people. The expectation would be more appropriate, right? Because if you ask, what would be your expectation about the market? And of course, they will talk about COSPI return, right? So if our stockholders are mostly the local investors, then it's better to use the local RF and RM. But beta here, remember, we just did it here. So this one is better to use the local firm as a representative, but this one is better to use home. Then you get the beta of the project. Then you get the cost of equity, required return by stockholders. So it's not difficult, right, to calculate, okay? It's never difficult to calculate because we have calculator, we have Excel and everything. But the point here is what inputs we interpret or we define. And there's nothing right, nothing wrong. It depends on how you argue about it. Any question about cost of equity before we continue with the cost of debt? See, the story is quite long in the text. I tried to summarize everything, okay? But to summarize everything, I mean, yeah, keep reading the textbook. That will broaden your knowledge and perspective. But I try to summarize everything so you can understand faster and to the point, right? More straightforward. Yeah, just that. Any question about the first component, the cost of equity? Now the second one, we have the cost of debt. So this is very easy. What our discussion so far, you can ask a bank, or you could calculate the yield to maturity of another bond, another company bond, okay? But here, what makes it a bit complicated is the exchange rate. As always, right? This is our course, International Finance, Global Financial Markets. So everything is made complicated by the exchange rate. So things would be quite easy at the beginning until you realize that the borrowing is in another currency. So let me use LOC, okay, LOC as example. LOC, because you came from Vietnam, okay, you can imagine this easily. Let's say, LOC, maybe my first question, do you have a high-speed train in Vietnam right now?
Not yet.
Just normal train, right?
Yes.
Okay, good. Yeah, that would be a good. Let's say here, maybe who is it? Yeah. So I'll go back to Nathan. Okay, Nathan. So Nathan, you're a Korean high-speed train. Okay, this will be quite easy to imagine. So Nathan, you try to sell the high-speed technology to LOC. Let's say LOC is the Prime Minister of Vietnam, and you are the Minister of Finance of Korea. Okay, so you try to sell. Okay, I have this technology. Okay, do you want to buy it? And to make the project attractive, Nathan, you tell LOC. Okay, you tell the Prime Minister, I can lend you the money also. You see, one package, right? This is more attractive. I will build the high-speed train, high-speed railway in Vietnam, but I will lend you the money also. So don't worry about money, okay? I will lend you the money and I will give you a very low interest rate. What is that? What is the interest rate? 0.1% per year. Wow, LOC, are you interested, LOC? So the Korean government through Nathan, right? Nathan wants to, Nathan is offering you the high-speed railway technology, but he's also willing to lend you money with an interest rate of 0.1% per year. Is it interesting, LOC?
Yes.
Yeah, of course, right? It looks very low. The interest rate is very low. However, here's the thing, right? You have to repay the debt and the interest payment and also the principal in won. Now here you have to be wiser, because now 0.1% is in won, and your currency is down. Is it down or down?
Vietnam dong.
Yes. Dong. Vietnam is dong. So you make money in Vietnam, right? So you make money, you sell the tickets to Vietnamese, mostly Vietnamese. Then the revenues and then the income will be in Vietnamese dong. Now you have to pay your debt in won. Be careful. What is the risk there that we have studied so far? Currency risk. Okay, the currency risk. Now you have to estimate the currency risk, and you might find out at the end that actually in Vietnamese dong, the interest rate is maybe 1.5% per year, not 0.1. So 0.1 is in won. Like what you did, remember the SA, what's it, Carrefour SA case, so remember? The debt was in different currencies, so you have to be careful with actually the number. So let's see an example here. American company is borrowing 10 million euros for 1 year at interest rate of 7%. So you can say that, we can easily say, oh, what is the cost of debt? Cost of debt is 7%. Of course, what is the cost of debt? Obviously, we know the number here, 7%. However, remember, now the debt is in euro. Okay, have to be careful, right? So let's see the information here. The spot rate is $141 per euro, and then you borrow 10 million euros. How much is it in dollar? You multiply or you divide? Multiply or divide? Anyone?
Multiple.
Multiply, yeah, you multiply. Yeah, multiple. Yeah, you multiply them, so you get 14 point. Yeah, here. Yeah, this is in dollar. You multiply, right? Because they're the same at the back. Remember, they're the same at the back. So you multiply, you get $14.7 million. Oh, sorry. The spot rate is this, 147. 147. Okay. At the end, the exchange rate 1 year from now is 141. Okay, 141. So we'll pay how much? Actually, we'll pay of course we will pay 10 million pounds plus 7%. So we borrowed 10 million. And of course, when we pay it back next year, it should be what? 10 million multiplied by 7%, 1.7%. So we get, how much is it? 1 million and is it 70? Yeah, 1,070,000, I suppose. Yeah, for 1 year, that's correct. Okay, but you see here at first, the dollar would be what? 147. So obviously we get how much in dollar? We multiply, we are the same at the back. So $14,700,000. Okay, and then at the end, we have to pay 1,070,000, and how much is it? What's that? The spot rate next year, we know from this information, 141. So euro has declined. Right? Euro has depreciated. You see, from 147 last year, now 141. So euro has depreciated. Euro has depreciated. How much is it? Multiply or divide again? Yeah, we multiply, right? So
multiply
1 million multiply, yes, 1,070,000 times 141. Okay, so at the end, actually, we have to pay sorry, so this is not 1,070,000, but 10 million and is it 7% of 10 million? 700,000, right? 10%, 7%, right? Yeah. So how much is it? 10 million and 700,000 multiplied by 141. So 15 million. Okay, so you see, so we bought at first, when we translated our borrowing into dollar, we borrowed $14.7 million. Actually 10 million euros, but if we translated it back, it will be $14.7 million. But at the end, we have to pay this much. How much percent is it? So 15 minus 14,700 divided by 14,700,000. Let's see how much is it. Anyone? Do you get a number?
.0263.
Okay, so 0.0263. Yeah. So how much percent is it? 2.63%. Okay.
Yeah.
2.63% only. And what is the status of the borrowing? 7%, right? See, actually, it's much cheaper in the what's that? In our home context, because you see the euro has depreciated, so we are fortunate. This is favorable, good position for us. We are happy. Actually, our borrowing has an interest rate of 7%, but you see the reality. What is the reality? Only 2.63%. Okay, so So what is the cost of debt then? What is the cost of debt? Then it's more appropriate to say the cost of debt is 2.63 rather than 7%. Okay, so I think this is the complicated thing about the currency risk, about the cost of debt, but other things are quite straightforward, just the same. But if you do the business at home, you're a Korean company, you only do the business in Korea, then everything will be easy, right? You go to the Korean bank and you ask, if I want to borrow this much, how much interest should I pay? Then you get the cost of debt. Again, what is the cost of debt again? Cost of debt, required return by creditors. Required return by creditors is the cost of debt to us as a company, right? So here, the cost of debt is only 2.63, not 7%, right? Because of the favorable position in the exchange rate. Right? So how to, this is the formula. Actually, you don't need to memorize the formula. It's just, you know, the quick thing to do. So you have the interest cost plus the exchange rate change. That what we just did. What we just did, we compare. Oh, this is in the original currency. What if I translate it back to my own currency? What would be the real interest rate? So here, if you want to be quick, here is the interest rate multiplied by 1 plus C. C is the appreciation or depreciation. In the previous case that we just saw, it was a depreciation. So appreciation or depreciation. So it could be both ways. Could be both ways. And C again, the interest rate, the nominal interest rate multiplied by 1 plus C. C is the appreciation or depreciation rate, and then plus C again. Okay, let's see an example maybe here. Let's look at the example here. Oh, yeah, maybe here, this one. So, okay, so we pay interest expense, right? We as a company, we pay interest expense 700,000. So we are paying 700,000 as interest expense. And remember from your accounting lesson and also practices, remember that interest expense could lower the tax rate. Interest expense could lower the tax payment. And let's say the tax rate here, 40%, the American one. What is the corporate tax rate in Korea? How much is it? The corporate tax rate?
25%.
Oh, 25%.
25%.
Yeah, 25. Quite good. Yeah, quite good. So in America, the highest before Donald Trump. Okay, Donald Trump cut a lot of corporate taxes. You know that. Donald Trump, yeah, among the good policies that he has, I think tax rate is one of them, or maybe the only one. I don't know. We don't know. So tax rate is good during the Donald Trump's administration, because I think now the American tax rate could be cut to 21% or something. Pretty good, yeah. But before Donald Trump, you know that the tax rate in the US, corporate tax rate could reach 39, or we could say 40, approximately 40. It's just crazy, right? You could go to the highest bracket of 40%. That's a lot of money, right? So let's say 40%, okay? So we have to pay 700,000 as interest expense, but we get the tax deductible facility. So actually, the worth of the tax expense is only 420,000. Okay, and let's say you borrow how much? You borrow 10 million. You borrow 10 million euros. Then your effective interest rate is only 4.2%. Agree, right? You are paying 700,000. But because of the tax system, actually it's tax deductible. So actually the after-tax cost of debt is only 420,000. Now 420,000 out of 10 million is only 4.2%. 4.2. So we know that here, this one is 4.2%. the RL, right? 4.2%. So what about the exchange rate? What is the exchange rate again? Do we know from the previous one? How much is it? Let's calculate again. 147 to 141. See here, from 147 to 141. So tell me again, which one has depreciated, which one has appreciated? $147 per euro to $141 per euro. Which one has appreciated, which one has depreciated?
Euro is appreciate. Dollar is
Euro has.
Euro is appreciate.
Euro has depreciated.
Euro is depreciate. Dollar is appreciate.
That's right. Again, how do you know it quickly? Very easy. Look, see, the number is decreasing. You see, 1.47 to 141. The number is decreasing, right? Decreasing. It means that the one at the back is going down. Just look at the one at the back, right? So 147 to 141. It means that euro has depreciated, going down, right? Has been going down. So dollar has appreciated, but see at the back here, the euro has gone down. Okay, so by how much? Let's calculate, yeah, by how much? So 141 minus 147 divided by 147. Can you calculate with me? How much is it? How much is the depreciation of euro? Depreciation, right? Depreciation of euro, how much?
Minus 4.08%. Minus 4.08%. 08.
Okay. So euro has depreciated by 4.08%. Minus, right? Minus means depreciation, right? Depreciation. So euro, see the one at the back, right? Euro has depreciated by 4.08%. So we put in the number here. Here. So remember what's the RL again? RL 4.2. So actually it's 7, right? 7%, but we have the tax. So the interest rate is 7%, but it's tax deductible, remember? Cost of debt is tax deductible because the interest expense could lower tax payment. Minus 40%, so we have 4.2 only. So 4.2% multiplied by, so what is the C again? Minus is 4.08. So let's calculate together now. 4.2 multiplied by 1 plus minus, yeah, plus minus, yeah, 408% plus minus 4.08%. So plus minus is of course, what's that? Minus. Anyone get something? So it's RL 1 plus C. C is the depreciation or appreciation, right? Plus C. So this is 4.2, 1, yeah, plus minus, right? Plus minus means minus, right? And then plus minus, this is minus 4.08. So of course plus minus is minus. So how much is it?
Minus 70.016.
Okay. Minus what?
minus 70.016.
Oh, I don't think so. Yeah. What is it? No, I don't think it's too big. Too big a number. I think. Let's calculate one by one here. What is it here? One
minus 0.05.
Yeah, I think so. That's I think more probable. Let me calculate also. Okay. That one makes sense. I think. Yeah, smaller.
Minus 5.136%.
Is it? Do you get anything like this?
Yes.
Yeah. Yeah. So minus 0.05%. That is the what's it, the cost of debt because of So actually our cost of debt, you see, right? The original cost of debt is 7%. But because of tax deductibility, you could lower tax, it becomes 4.2%. Why is that? Because 7% multiplied by 1 minus tax rate. Can you imagine, right? So 4.2%. So our cost of debt, according to euro borrowing, is 4.2%. But because euro is depreciating, I see here, it's depreciating, then we get an advantage, right? We get a big advantage. And it turns out that our cost of debt after taking into account the exchange rate risk is only only 0.05%. Really good news, right? Really good news. Okay, very happy, happy situation for us, for the American company in this case, right? The home company. Okay. Yeah, there are many other things I know, but I don't want to make you too tired. Okay, so, but yeah, but again, the calculation itself is not difficult. Okay, but the definition and interpretation of inputs, because there's nothing right or wrong here. We go international, right? You go somewhere, and you have to see, you have to consider the tax situation also. Tax credit, right? This is another issue that you can read from the text also. For example, you're a Korean company, you go to Vietnam, and the project will be taxed in Vietnam. When you go back to Korea, you can tell your government, oh, I have been taxed by the Vietnamese authority, please don't tax me anymore. So you might get this, right? You might get a tax credit because the project has been taxed in Vietnam. So maybe your country will not tax you that much because you get the tax credit. So there are a lot of regulations, something like that. But one more thing, okay, before we finish, there are two types of international operations. The first one is subsidiary. Subsidiary means you have, we call it SBU. Are you familiar with SBU? Strategic Business Unit. Strategic Business Unit. So this is not a spun out company. So this is subsidiary only. For example, you are LG, you go to Malaysia, maybe LG Malaysia. So it's subsidiary, right? But another possibility is you make a new company, but you own the company, but this is we call it what? So spun off company. Spun off comes from the word spin off. Can you imagine? I spin off something. I spin it out. I spin it off. So spun off company. This is like you own the company, but the company is independent. So this one, the capital structure would be quite independent. Okay. For example, the company goes to Malaysia, it has its own assets. It has its own liabilities. It has its own equity. All right. So this is more independent. But for this one, actually, it just follows. See, for example, here, you borrow money for the company. okay? You give it to the subsidiary. Then it doesn't really matter because the recording will follow the parent company. So you understand what I'm saying, right? Let's say the subsidiary borrow money in Malaysia. So that borrowing is also the parent's borrowing because this is not a spun-off company. This is part of the parent. So it doesn't matter, right? So it doesn't matter who borrowed the money. For this one, the capital structure will be exactly the same as the parents because it's only a subsidiary, right? Subsidiary is not independent, right? It's SBU only. LG Malaysia, LG Thailand, or whatever. But this is spun-off company. Let's imagine that maybe Lotte, you go to, you go to China, you build a company there, a joint venture, okay? But the company is a spun-off company, so things will be quite different because now the company, is an independent company, and if you don't own more than 50%, you cannot use the full equity method. So you cannot admit all the profit as your profit, all your assets as your assets. You understand what I'm saying, right? Because this is independent and you don't own the majority, you don't own the super majority share. Very different from this one. But for this one, as a subsidiary, it doesn't really matter who borrowed the money. The parent borrows the money and give it to the subsidiary, or the subsidiary borrows the money by itself in the local market. It doesn't matter. See? This will always look the same, the balance sheet. It doesn't matter who borrows the money, be it the parent or the subsidiary, because the subsidiary is not an independent company. Right? The balance sheet will be always reflecting the parent's balance sheet, right? Okay, so yeah, I know the topics is still long, okay? If you read the text, still there are a lot of sections, a lot of pieces of information that you can learn from. But I think we have seen the core topics, okay, about the cost of capital for the international context, okay? And next week will be our last meeting. We have the capital budgeting topic, capital budgeting about NPV, IRR, but for the international context. That's what I'm saying, right? In the corporate finance context, if we only do the business in Korea, everything will be like more simple, more straightforward because we don't involve the exchange rate risk. We don't go anywhere, but we make money there, we produce there. But now when we talk about the global financial markets, we have to go somewhere. There are a lot of other factors, right? Other noises that will affect our numbers, okay? Okay, so to end the course, I will hand it to group 4, okay? Very interesting topic, Caesarea. So it's about some disappointment by stockholders about the announcement or something like that. Yeah, group 4, please, you can tell the story and try to give some answers to the questions.
Yeah, let me share my monitor.
Yeah, please.
Okay, presentation start.
Okay, hello. Let's start. This is index. Summary of Caesarea case. Introduction. Caesarea, a Japanese restaurant, it provides healthy Italian food too. At a very reasonable price, the restaurant opened in 1973 and currently employs more than 3,000 employees in Asia. The restaurant enjoys considerable growth in its operation, and it is now operating in Japan, China, and Taiwan. Saizeriya orders in materials mainly from Australia, which accounts for almost 1/3 of its total food demand. The procurement from Australia results in the foreign exchange rate risk. The management of Saizeriya uses foreign coupon currency swaps to manage this risk, which remains quite useful for Saizeriya in the past. However, in 2028, the restaurant incurred a substantial loss from the usage of different coupon currency swap. These operational losses from the various coupon currency exchange are heavily highlighted in media and result in the negative publicity for the restaurant. The shareholders were very concerned about the losses because the going concern status of the company was at stake due to these losses. Problem statement. Everything was going right. The company was earning enough profit and the revenue was increasing. The cost of goods sold was also decreasing. The growth prospects were positive, and the shareholders are also happy about the performance of the company. Saizeriya was using the support. Okay, currency coupon swap for the hedging of payments to the Australian suppliers of materials. The hedging instrument employed by Saizeriya was capable of generating high losses and profit if the exchange rate moves unfavorably and favorably. As the Japanese yen appreciates, it impacted the result of Saizeriya. The profit of 4.2 billion Japanese yen converts into the losses of billions due to the losses made by the derivative instrument. The position of the bank, the reputation and position of the bank are also affected by the loss Saizeriya have incurred. Although the bank is getting tremendous profit from the deal, the reputation of the bank might be impaired because it has been in the media headlines for a long time. Furthermore, the Saizeriya is also planning to sue the bank for the losses it generated due to the loss on derivative instrument. Facing legal proceedings might have many negative consequences on the future of the bank. Many of its current customers might not enter into the business with the bank because of the impaired reputation and integrity of the bank. Furthermore, if the bank is found guilty, then it might have to pay damages to Saizeriya. The penalties are also expected to be imposed by the regulatory authority if we found on the wrong side of the law. On the other hand, the financial position of the bank will be improved and confident because of gain it got from the deal with Saizeriya. Furthermore, the bank might be correct because it is also of fiduciary duty to its shareholder to increase and maximize their wealth.
I will analyze the coupon swap of Saizeriya. In October 2007, Saizeriya changed the contract to a high-risk, high-yield derivative contract designed to make the company profitable. If the yen is higher than 78 yen in Australian dollars term, Since the yen index remained in its 80s for the past 10 years, so Saizeriya expected that the yen would not increase. If you look at the chart below, it was the right decision at the time because it is a structure which profit are limited and loss are infinity. At the time of signing the contract, it was 10 yen, 100 yen to the Australian dollar. But in December 2008, it drops to 62 yen. If numbers fall below 78 yen, the company had to face a loss of 500 million yen for every decline per 1 yen. In 2 years, a total of 10 billion yen was lost. The main reason for this loss was due to the global financial crisis caused by the bankruptcy of Lehman Brothers in September 2008.
Years?
With the coming of a global financial crisis, the demand for dollar, gold, and yen, which are safe assets, surged. After September 2008, the yen soared to 25% in value. The currency value of the Australian dollar, a main export-oriented economy, plummeted. It goes down 38% for 3 months after August 2008. The value of the yen per Australian dollar surged about 40%. Futures options have 15 to 20 times the leverage of their normal value, stock, real estate. Thus, since the currency was under a loss occurred.
Hello?
Hello?
Yes.
Can you hear?
Yes, yes.
Okay, sorry. Evaluation of disclosure decisions. Saizeriya shares fell sharply on news of the swap losses. Saizeriya announced 6 days before its general shareholders meeting in November 2008 that it would likely incur an appraisal of loss of 13 billion yen on derivative contract in the September and November period. The loss eventually increases to 15 billion yen due to the cancellation of the contract. On 9 December 2008, Shogake, president of Saizeriya, made a public announcement as to losses caused by the use of foreign currency coupon swaps. As a result of the disclosure, Saizeriya's share price declined its cap on December 10, 2008, as investors hurried to abandon the stock. After gradually falling in the morning, the stock hit a limit down trigger level of 1,485 yen, down 300 yen or 16.28% from the closing price in the previous trading session. About 70,500 shares changed hand and sell others totaling roughly 9 million shares went unpublished at the day's end. Some directors and shareholders questioned Saizeria's disclosure. Saizeria's stock price plummeted following the disclosure. The Japanese rules were not clear regarding what was subject to disclosure, but Shogaki was confident that he had done the right thing and believed that the transparency would eventually be appreciated by the shareholders. Why did Shogaki decide to disclose the loss? Shogaki held a press conference and explained why. Part of the company was reluctant to disclose losses, but Shogaki decided to proceed with the disclosure because he believes it will be appreciated by shareholders. Also, Shogaki wanted to clarify where the responsibility was, and derivatives trading kept an eye on the foreign exchange market and wanted to cancel when the losses were listed. Did Shogaki make the right decision? The documents required key information to be published just once a year in principle, and it was not very clear what was subject to disclosure. Whether the risks were unique or not, one thing was certain. Companies needed to step up the disclosure of information that was useful to investors. Shogaki also studied the US case of derivative disclosure, and the US requirement encouraged him to proceed with the disclosure of the loss due to derivatives. Insufficient of non-existent corporate disclosures about risk factors that could negatively impact the business have a serious impact on investors and business partners. Saizeria's share price fell after the loss was disclosed, but Shogaki's decision to disclose it is considered correct.
Okay, next I will tell you about the difference between hedge and speculation that I learned from this case. First, let me explain the hedge. What is hedge? Dictionary definition is a row of bushes or small trees, usually along the edge of the garden, field, or road. Meaning in business field is an investment position intended to offset potential loss or gains that may be incurred by a companion investments. So, why should a company hedge? It's simpler than you think. The reason for the existence of a company is ultimately to create profits. Of course, there are a lot of other reasons too, benefiting the world by lowering transaction costs, fulfilling social responsibility, and so on. But fundamentally, profit creation comes first. Only then office workers like me can live by paying off their loans. So, what do you do to maximize your profit? It can be organized in three directions. First, companies must monetize their own business that they do well. For example, if I'm a CEO of Apple, the iPhone 12 came out, so I have to make and sell the next iPhone 13 right away. Perhaps, if I'm the CEO of Amazon, I thought the untact would be lasting due to COVID-19, so I was pushing for drone delivery quickly. After all, a company must make a profit from its sales activity, not from other investment activities. The second is to reduce expense and losses. That's why companies build factories abroad where wages are relatively low. Finally, to do the first and second well, companies will have to avoid possible risk. The risk here can be both uncertainty and volatility. Nigeria's currency coupon swap, in this case, was also to achieve number 3. As raw materials are imported in Australian dollars, this was to reduce volatility. After all, reasonable hedge is necessary for companies to maximize profit. But why do you think we should hedge? As explained earlier, in order for a company to make a net profit, the profit must be bigger than the expenses and other losses combined. If the expenses and losses are high, then the company loses. It has failed to manage the risk. That's the case with Sigeria. The currency swap had a structure with too great a possible loss. Actually, the loss was huge. Sigeria President Shogaki said, "I never imagined that 2 years' worth of pre-tax profit would be wiped out instantly by the derivatives trading. Overhedge is not a hedge, it's a speculation." Nigeria might have had a slight desire to benefit from financial investment. There is a similar case in Korea, so I'd like to introduce something. In Korea, problem product was a currency option, not a swap, also known as KICO. From 2008 to 2010, 738 exporters suffered huge losses from this currency option. The size of the company's losses were 3.2 trillion won. With a single product, it has suffered a record amount of damage in Korea. We will look at in detail in the next chapter. These currency option products are formed by purchasing put option with barriers and selling call options as a hedging tool against the risk of exchange rate fluctuation in export price. It is usually set by buying one put option and selling two call options. Take a look at the payoff example below. This product is advantageous to companies only when the exchange rate moved within the specific barrier. As everyone knows about options, in short, a call option is a right to buy an underlying asset at a specific price. And a put option is right to sell an underlying asset at a specific price. Suppose the exercise price of the put and call option is 931. First of all, when the exchange rate moves between 960 and 931, the company originally obtains the exchange rate gain from exports, but the options are not exercised, so there was no effect. And when the exchange rate moved between 930 and 901, foreign exchange loss is incurred due to exports, but it is hedged because the exchange rate is tied by exercising put option price. And when the exchange rate falls below 901, the put option is cancelled. So there was no foreign exchange hedging, resulting in a foreign exchange loss due to export. There's no big problem so far. But the biggest problem is when the exchange rate goes above 960. The company generates foreign exchange gains from export, but the call option is exercised and dollar has to be charged for 931. The bigger problem is that this KICO product is designed with overhedge. Selling a call option is twice as much as buying a put. Even if a company receives the export price and prepare $1 to pay as a call option, it is only a multiple one, and the remaining multiple must be obtained on their own. If the exchange rate rises above 1,000, the loss according to the contract becomes enormous. The possible loss is infinite. So let's look at the exchange rate in Korea at the time. As you can see, the reason why companies sign this product is because the fluctuation in the past exchange rate was small. However, as everybody knows, 2008 financial crisis caused the exchange rate to rise sharply. Eventually, by 2010, companies lost about 3.2 trillion won. However, I think this situation is not the fault of only companies that have a contract for a product called Kiko. Financial company like bank are also responsible for failing to properly explain this dangerous product. That's why the Korean Financial Supervisory Service is currently advising companies that have been damaged by Kiko to compensate for a certain amount. Our presentation will be up this point. And
okay. Thank you very much. Very good illustration also about Kiko. So you hold one put option and sell two call options. Okay, that's the actually the way to minimize the cost of doing the option. But actually, yeah, this case about Kiko and also Saizeriya, our main case, it's actually a reality in corporation that we are facing every day. Just how to communicate that to our stockholders and also to the media. I think because not everyone understands this. That's the problem, right? So if we are saying that, you see the case of Saizeriya, why they went to the the swap contract at the first place, because they had an exposure. I see the very simple case here. They were importing a lot of products from Australia, and what are they afraid of? What were they afraid of? Of course, the Australian dollar would appreciate. That's what they were afraid of. Right? So they were afraid of appreciating Australian dollar. That's why they went into the the coupon swap contract. The coupon swap contract that say they would get money if Australian dollar appreciated. But we know what happened from the story, right? We know what happened. Actually, Australian dollar depreciated. It went down. So actually, yeah, let me borrow the screen again, okay? I will do it quickly. Yeah, to end the class. So actually, if we talk about business, and if all people understand about the mechanism, then nobody should complain. But because not everybody knows, and I think that was Shogaki, the president, he didn't realize that the media was very harsh, you know, not friendly because of the announcement. So there was a misexpectation actually. So he thought that the stockholders would appreciate what he did, but it turned out that actually everybody was angry and then he was in trouble, right? But if you think about it, this is quite normal because you import, right? You have a lot of import and you have to pay in Australian dollar. And of course, we talked about this for several weeks, for so many weeks. What are you afraid of here? And in that case, they were afraid of appreciating dollar, because they will have to pay, and they have to pay their import, their expenses in Australian dollar. So they don't like this, right? They don't like this. That's why they do the swap, coupon swap. So the coupon swap, they're expecting that here's the real business here, real business. So if Australian dollar does appreciate, they are unhappy. We remember our discussion several weeks ago, right? In the real business, this is what they don't like. If Australian dollar does increase or does appreciate, they will not like it. They are unhappy because they have to pay in Australian dollar, and Australian dollar goes up. Of course, they are unhappy. But they have made this contract, the swap. In this case, we are talking about swap contract. Actually, you could do it with option contract, what Moon explained in Kiko. They could use also forward or futures that we saw several weeks ago or whatever. So expectation here is that if Australian dollar does increase, Australian dollar appreciates, they will get money here. You see the idea? This is called hedging. right? Hedging explained by Group 4 as well. So this is what the situation they don't like, but they'll get money here to compensate for the loss they will suffer in the real business. However, what was happening was the contrary. We know the story, right? What really happened? Australian dollar depreciated from 100 something, right? 120 to 80 to 78 or something. I still remember the story, right? So actually the real situation was the contrary, right? On the contrary to what they feared for, what they were afraid of. So actually Australian dollar depreciated. So actually what was happening now? The depreciation of Australian dollar actually made them very happy here. Why? You can imagine, right? If you import something, you have to pay it in Australian dollar, but it turns out the Australian dollar depreciated. Actually, it's exactly like what our example in the textbook, remember? So we borrowed money in euro, but it turns out that euro depreciated. So we are happy, right? We're super happy here. We have to pay in Australian dollar, but Australian dollar depreciated or has depreciated. But remember, we already had this contract, the coupon swap contract, and here, because we try to do the reverse situation, we are unhappy here. This will constitute big loss here. Here's the problem, right? When Shogaki or whoever, maybe from our company, a Korean company, for example, when we announce this, not everyone understands. You understand what I'm saying, right? Not everyone understands the situation because people say, "Oh, you see, you're crazy. You see, you make a big loss here. You create a big loss here. You see, what have you done? You know, you're a bad executive. You know, you have created a lot of losses from the swap contract. But actually, if you see the big picture here, it's okay. It's okay, right? Because we are doing this for hedging, and if the Australian dollar actually depreciated, we will be happy here. Yeah, they would be very happy here because now they only need to pay like smaller amount of money in yens relative to the Australian dollar because the Australian dollar has depreciated. But here, of course, they suffered or they incurred a big loss. It's like insurance, right? Well, like insurance, like if nothing happens here, you still have to pay a premium. Common sense, right? If nothing happens here, you pay a premium. But if something happens in your to your property, to maybe your loved ones, of the health or something, then you get money from the insurance. It's similar here. But again, not everyone understands this mechanism, okay? Especially the media. The media doesn't care. Okay, you make a big loss here. You make a big loss here. This is your mistake. But they never see this side, okay? This side of the story actually is doing well there because now they're happy in the real business. But of course, they incurred some losses in the swap contract. Okay, so I think that's not only the technical problem, but also media problem, you know, how he explained that to the media or something. Shogaki guy, the guy named Shogaki, he was in trouble. Yeah, so I think this is quite. Yeah, it happened every day. Yeah, depending on how you explain that to the stockholders, right, during the annual meeting, and also to the media. And I could guarantee you, media doesn't understand, and media doesn't care. Okay, media doesn't care. Okay, they only know that you make losses there, and that will be a big news. Once again, we give applause to Group 4. Thank you very much. A good presentation, a good and also good illustration. Yeah, thank you, Group 4, and to all of us here. Thank you. Yeah, this is quite long today. Sorry for that. So yeah, I think we'll end the session soon, and you can have your Saturday night and can enjoy the time with your family, with your loved ones. So yeah, I will send you the materials again for next week as usual. Thank you, and yeah, have a nice weekend. Yeah, enjoy.
Excuse me, Professor. Excuse me.
Thank you.
Oh yes, please.
I have a question next week about the exam. Could you please tell us more details about the exam next week?
Okay. Exam will be quite typical. I mean, I think you'll be given 2 hours. You can do it anywhere. It's essentially a take-home exam, so you can do it anywhere. And you submit it to the iCampus system within 2 hours. So you'll be given 2 hours. So questions will be, I haven't made the questions, but it will be Yeah, normal questions, okay? No spectacular, full of tricks or traps or something like that. There's nothing like that, okay? Just normal questions, typical questions, problem solving. So 2 hours.
Yeah, but the exam will be next week or the week after next week.
I'm not sure about that, but I think next week we still have our last session, right?
Okay.
Session number 8, I suppose. Yeah, I suppose. So, but actually the exam can be held anytime, because as long as you have 2 hours, maybe at night or on Saturday or any time you want, as long as you have 2 hours, yeah, you work on it anywhere and then you submit it on iCampus. So you don't need to show yourself and you are doing it here now. You can do it anywhere. Yeah.
Okay.
So
okay, thank you, Professor.
Okay. Yeah.
Yeah. Is there a test for
Thank you.
the calculation?
Yeah, mostly problem solving, I think. Problem solving means, yeah, it will involve calculations. But again, you can do it anywhere. You can open any book, it's take home open book exam. So it's not closed book. So yeah, don't worry about that. You can do it anywhere. You can open any textbook or laptop or anything.
So if we submit the solution, so maybe the most of the your question is, maybe you said that it's a calculation, so we need a pen and take a picture for it. So is it okay?
Okay. Yes. Okay. Perfectly okay. So if you want to type, it's okay. You want to write with your pen, you want to take picture, it's okay too. No problem. Yeah. As long as you have the answers. Yeah. Yeah, you can write, you can type. Yeah. If you prefer typing, then you can type. If you prefer writing, you can write. Right? Doesn't matter. Okay. So yeah, good luck everyone. You can study concurrently, but I think we still have a session next week. So yeah, we still have time for that. So have a nice weekend.
Thank you.
Thank
Have
you.
a nice weekend.
Thank you.